Hello and welcome to this Forex Preview at xm.com. I'm Maria Pachardis, and joining me is Senior Investment Analyst Marios Hadjikyriacos. We'll be discussing the Fed meeting due to conclude on Wednesday at 1800 GMT and the potential reaction in the dollar. So Marios, the U.S. economic recovery from the pandemic is driving the current surge in inflation, now running at 5%. This would usually have markets panicking and the Fed talking about rate increases. So why is this not happening yet?
Hello, Maria. That's a great question. So it really comes back to the labor market. So the overall US economy, inflation is doing well, consumption is doing great thanks to all these spending packages, but the labor market is not quite there yet. Employment levels are still quite far away from their pre-crisis glory, let's say. Now, why is that important? Because the labor market is not quite fully healed yet, that's making the Fed more confident that this inflation shock is going to fade pretty soon. So if full employment is still far away, that means consumers just don't have the pockets to keep the spending going, and that implies that inflation will ultimately fade. And the markets agree with that because if you look at longer term inflation expectations, for example, those have been relatively stable and even declined a little lately. So the market is not really buying into the inflation narrative either. Everyone's saying this is, inflation is high right now, but it's going to fade pretty soon. So nothing to panic about. Therefore, what does this imply for the Fed this week? I think that they're unlikely to signal that they have started a discussion about exiting their cheap money policies. Chairman Powell might indicate that the discussion is moving closer, but it hasn't started yet. And in fact, I think that most of the attention might fall on the so-called dot plot of interest rate projections, which could signal a rate hike for 2023.
Okay, so if the dot plot ends up showing a rate hike for 2023, what reaction can we expect in the dollar?
Well, normally that would be a pretty hawkish sign that would argue for a boost in the dollar, right? Interest rate increases are coming closer. However, I don't think we're going to get a huge reaction this time because the markets have already priced that in. If you look at market pricing, the markets have actually priced more than one rate hike for 2023. So one rate hike and a pretty good chance for a second one during that year. So this wouldn't be any huge surprise. So perhaps a boost to the dollar, but a relatively minor one. Now, as far as the bigger picture is concerned, I would say that we are not going to get anything huge from the Fed this week. Policymakers really want to avoid market panic. They'll probably try to make this tapering process as slow, as gentle as possible. So tiny baby steps towards a normalization. Now, what does that really mean? It means that the real shift might come in late August or in early September. By then, the jobs market is going to be much stronger, and the Fed might signal that we'll start formally talking about tapering. Now, for the dollar, that implies that any real strength is probably a story for the late summer. When it becomes clear that the next move is for the Fed to tighten liquidity, the dollar could come back to life again, particularly against the low-yielding currencies whose central banks are not really going to move in the same direction, like the yen and the Swiss franc.
Marios, thanks so much. And thanks for joining us at xm.com.